All right. So today's webinar, the first one, actually all of them, would be about cycles. Now, it's not a secret that our club trading is all based on cycles combined with divergences and the convergence, right? That's the most important principles in trading that technical analysis could have. Now, there are many approaches to cycles, there are many approaches to divergence, there are many to convergence, there are many different views. I will show you the ones that I have discovered, and discovered, maybe it's not the right way because I did not create it. It's not like I discovered something totally new on mathematical tricks. No, that's principles that exist on the market, but I use them a bit different way because my background is from inside of the hedge fund house. They don't look on the charts the way we do. They all use numbers, pure numbers. So my uh, main job on the last few years was to understand and define how to use their numbers, their principles, how they write options and how they trade options and futures, and how that would be looked, right, and placed on the chart. And that took time to develop and everything. So that's basically the entire art of cycle. That's what we are doing. And as I promised, I will create the webinars to talk about all that. And this is exactly what it is about. So this webinar is part number 1 of the series of cycles, what they are, how do we use them, how do we trade them. So the first now would be basics of the cycles. We will talk about what are cycles, why do cycles appear, types of cycles, and of course, examples. I will give you many tips here that should save you a lot of headache in the future. So I will need from you guys that's a lot of focus, attention, and patience because you are many, I am one. I will need you to give me the chance to explain everything, and I will give time for questions. If you have any question, put it down, it will be answered. But please ask questions according to what we learn, right? Don't start asking questions. How do I join the Skype? Okay, out of subject. So let's keep it pure uh, chart. An example. So what are the cycles? The first important thing to understand, cycles, it's not a trading strategy. Now, cycles could be named any way you would like. Waves, trends, I don't know, lines, uh, linear lines. Some call that with some confuse it, not call it, with Elliott waves or Wolf waves or any other waves exist in the technical analysis, and that's completely wrong for one purpose. The waves is the way to analyze these cycles. Cycles that are very, very clear and clean. There are only options, only few ways that they could appear as not as any other waves. And that's why very important to explain. Inside the cycles, there are many inner waves which could be defined by any principle, including Elliott waves. And no, I'm not a master of Elliott waves. Never was good at that. Probably would never be. Just not my type. If you want a master of that, my friend Nikola, he is the master of Elliott waves. I myself, no. Never could be a good friend of that. So the first important thing to understand, cycles, that's not a strategy. Cycles, that's a simple way to give us the direction in which should we trade. Any, and I repeat, any trading strategy could be applied along with these cycles, which means once we know how to define a cycle and what direction to trade, I do not care what strategy you would apply. I'll show you one of my strategies on these webinars, not this one, the next one we will have on the list, step number 2. But as I said, it does not matter what strategy you will use, and I will explain you why later on. Cycles are more powerful on the higher time frames, like everything else. That's what means we always, and I will repeat again, we always start from the weekly chart and then we go lower. So we start weekly, daily, and then we are looking for the ways to trade. Okay? And cycles allow us to get amazing risk-reward ratio. On a very rare occasions, it could be up to 1 to 40, very close to 1, my maximum profit ever I had, the biggest one, in one trade. Okay, 1 to 40, that's amazing. Just 1% risk, 40% gain. Of course, that's very rare. The classical ones are 1 to 2, 1 to 3. And the next popularity is 1 to 5 up to 1 to 7. And sometimes rare risk reward happens as well. I'll show you everything how we define. So cycles represent the move of the big money behind the scene. What is the big money? What is the big money? Banks, hedge fund house, institutions, this or other way around, and sometimes some big private industries or even persons. It's very rare in the forex world, almost impossible in the forex world, but it's very typical in stocks, sometimes in other instruments as well, and mostly it appears on options and commodities as well, and all the variations. Forex is hardest part because no one, doesn't matter how big he is, private, cannot change the market. Unless your name is Donald Trump and you just tweet something and then boom, you get a reaction. But just joking, of course, joking aside, that's an immediate impact, not something that changes trend forever. Okay, so that's really different. Now, the main thing comes from options trading. Okay, what is an option? I believe that all of you know, but just an idea. Okay, to have a contract, sell something at one price in order to be able, or to buy something at some price in order to be able to sell that later on in some expiration. If you are good in the money, you make great returns. If you are bad, you always have your commission if you write options, and so on. So basically, that's have some future contract to expire if you believe it would be above or below specific level. That's why when you buy option or you write option, and then you earn your commissions. It's same for calls and puts. Calls is when you believe something going up. Put when you believe something going down. Translation to our language, buy or sell. That's the basics of the basics of the basics. I'm not going to dig very inside because options world is not an easy world to understand. And I'm talking about, of course, the professional level. That's a bit different with all the numbers and the strategies inside, with insurances, blah, blah, blah. We don't need that. Now, the bottom line is when the option expire or created, right? They are created in specific patterns, which we, the retail traders, can see in a visual way, which I call the cycles. When there is a cycle on the chart, any type of it, the chances are that the smart money, the same big money, those that create the positions and the expirations, they are involved in the market. And this is the exact point where we want to be. We want to be involved when they are. Why? Because we want, it's much smarter to surf the wave, right? When you are with the wave and not against the wave, right? It's much smarter to run with the wind and not against, right? Right? Correct? So this is the same here. We want to be with the big forces. There is a great saying here, if you can't beat them, join them. So we want to join them. We are not heroes. No one wants to be a hero, right? We just want to be smart and join the big guys. That's all. Now, any questions by far? Or so far, so good? So far, so good, huh? All right, great. The types of the cycles. Now let's talk about the few cycles. Actually, we have three main and one more ugly, the one that normally no one loves to deal with, and there is one reason for that, but I do love to deal with that, and I'll explain you how. If you know how to do that, you know how to deal with that. The main one are regular in other words called a double cycle. That's the most common. Triple, special, and a range. Range is the one that no one loves to deal with. This is how it looks like. What did I do? Okay. All right. So basically, what do we have here? This is double. Two waves up, okay, or two waves down. That's a bullish double cycle, bearish double cycle. Double means two waves, and I'll explain you the difference between them. Triple means we have three waves to the upside or to the downside. And special means we have three again, but one difference, that the middle cycle, the middle leg of the cycle, right, is twice or thrice as the first or the last. So if the first and the last, they should be equal, pretty much, visually equal. That would be X, then this could be double X or triple X. The middle one, okay? This one. All right? That's the entire secret of the special cycle. Now, those of you who know the Elliott waves immediately start to count 1, 2, 3, 4, 5, and so on, right? As I said, this is a special cycle that could be divided by this, but this special cycle would be probably just one leg of bigger cycle, and that's why we don't dig inside calculations here or naming or waving. We just name it simple waves. That's all, to make it clear and understand it well. So that's the main cycles we will use. And let's now talk about each one and what it includes inside, how it looks. Okay. So regular cycle, as I said, the double cycle. Now, ideally, it consists of two equal waves. The two waves could vary in shape and duration. And that's correct for two situations. Now I want to go here for a second and show you the two differences. Now, there are, I'll make bullish, but it's same for bearish, okay? There are cycles like this. That's all a double cycle, both of them, all three of them. Now, the difference is that this X, these two legs are equal, but these two legs are not equal, and these two legs are not equal. Now, before we continue forward, let's quickly understand how do we at all find cycles on the chart. There is such thing called Fibonacci expansion. How do we use that? This is the sign. You see that? Here. Draw Fibonacci expansion lines. If you don't have it on your MetaTrader 4, go to this place this dotted line from the left, right click on it, customize. In the signs here, you would find Fibonacci expansion. Just make it insert inside and then boom, voila, it will appear in the selected one. And this is where you'll get it. Okay, that's the sign of it. How do we do that? We click on that. We go to first spot. We go to the second spot. So the first move from the beginning to the end. And then there is a small line. This is the correction line. And we measure that to the end of the correction, which is here. And we got 3 lines. 61.8, 100, and 161.8. There is one more that is 261.8, but that's like for expanded cycles with longer options trading. Not something that I really recommend to deal with. We don't need it. So that's how we do it. Okay, once again, we go here, Fibonacci expansion from the beginning of the move to the end of the move to the end of the correction. That's the 3 spots we have, 1, 2, 3, and we got 3 lines. So far, very simple, right? Now, here comes the important part. By the way, that's something I want to show you. As I said, we make it from beginning of the move to the end of the move and the small line to the end of the correction. Correction sometimes could be ranging. Let me show you what I mean. Like this. Let me show you what I mean. Alright, like this. Okay. We don't measure, for example, from here to here and to here and we say, okay, that's what we have. No. This is where this move up started from. See? So we measure that not from the first low point, but the last low point before the second leg of the cycle started. You understand what I'm saying, guys? Okay? That's very, very important because sometimes the correction is a range or triangle or whatever it is, and then the measurement is not like from spot to spot, but at the end of the correction. So sometimes the cycles are going like this. Okay, here and here. In that case, that's the same level or almost, right? But sometimes it's not. And that's why it's very important to understand that. All right? So now we know how do we use that. As I said, we got 3 numbers, 61.8, 100, 161.8. Now, I want to go back to here. And I want to show you the 2 differences. There is one classical cycle called double. The class. Oh, what is that? Drunk mouse. Okay, we have this. No, come on. What's going on with my mouse here? I have to just clean it a bit. Okay. The idea here is that these legs are equal. This and this are equal. What does equal mean? That we have 2. If remember the mathematics guys in the school, let's go back then. For some of you, it happened long time ago, right? So we have y and x, correct? Y and x. Now we want, the x represents, of course, the time, and the y is the size. We want them to be equal by size and by time. So if that was 20 candles, we want that to be pretty much 20 candles. Now, 20 versus 25, fine. But 20 versus 40 or 20 versus 10, not fine. So here comes the rule. What is fine enough, what's not? And my answer to that is use your eyes. Visual. I want to ask you a question. Okay? This and this. Do they look equal? Yes or no? Help me out here, guys. Exactly. Yes, they do. So now what about this? No, exactly. Now, they might be the same by size. So if that was like 100 pips, that could be also 100 pips. But the time, number of candles is completely different. What about this? You got my point. Again, size could be the same, but the time, right? And that's where the importance of the equal waves, the double waves, the ones that come to 100% expansion, 100% expansion, they have to be visually equal. This is the 100% expansion here. So this leg and this leg, they have to be visually equal. Now, another important thing. Sometimes the cycles do not reach the exact Fibonacci level because the market is not always Mr. Perfect, right? That makes sense. But what is good enough or not? So for that we have a simple rule. Our rule means 10% deviation. Does that sound scary, guys? No, it's not at all. Why not? This is our levels, right? Now take a look on this cycle, for example. 2 moves down, right? We have here 10 candles, we have here 8 candles. Do they equally visual here and here? Yeah, they are, right? But they didn't reach the 100% expansion. They reached almost. How much almost is good enough? We have 10% deviation. Very simple. What does it mean? Take a look of the entire move of the double cycle. How many pips it was? 500 pips. You see the middle number? It says 5,000, but because we don't use the last numbers, right? You know that. That's 500 pips movement. So we need 50 pips above the 100 and 50 pips down. So if that's 103.20, so 103.70 and 102.70, that's what we will use. Okay? 70 and 70. This is our zone of action. Once we reach inside, we will be looking for positions. Which positions? We will talk about that later. So far, so good. Okay, so we add this 10% up and down on each of the levels. Depends what level, of course, the cycle is ending on and where we want to start to trade. So far, that's basically what we need. By the way, I want to show you some important trick. I don't know if you use that or not, but let's say you have many lines on the chart and you want to delete all at once. You make Control B, Control A, and delete. And then boom, it deletes everything you don't need from your chart. I believe you know that. If no, here you go. I gave you some trick. That's all. You can put the tip in the glass. All right, so that's about the levels and the deviation. Okay, now we know that equal legs, they should be the same. Now what about the other levels, that 61.8 and 161.8? Here comes the trick. For both of them, the legs could be twice bigger or smaller. The second leg could be twice bigger or smaller than the first leg. What do I mean in simple language? If that was the first leg, that could be the second leg. And let's say this is 61.8 expansion of that, right? That could be 20 candles, that could be 40 candles. Twice bigger or twice smaller. So if that was 20, that would be 10. And that's correct for 161.8 as well. If that was 20 candles, that could be 40 candles. The 161.8 level expansion. All right? And same story, let's say like this. Boom, boom. Also doable. If that was 20, that could be 10. Now again, that could be 20 and 40, that could be 20 and 50. That's still correct. It has to be visual. visual, double, or sometimes even more than double, like triple. That's fine. That's fine. But that has to be visual. The second leg should be bigger or smaller, like twice or so than the first wave. That's the most important thing to understand. We do again 10% deviation up and down, so we create ourselves zone of action. All right, so that's basics of the double cycle. Now, here I want to show you once again something. Sometimes the cycles are very clear, like here, boom, boom. Sometimes the correction is not classical like here. Sometimes the correction goes like in double cycle by itself. Okay, and that's fine. We compare the first move and the second move always. That's why I told you when you move, when you measure the Fibonacci, you measure that from one point to second point to the end of the correction, the last low before the wave started up. The second wave started up. Sometimes you can say this leg, the first leg, is broken like one big and one more fake spike. That's also fine. Okay, this is the entire leg we measure. Don't get scared by that. Sometimes it's like a range, triangle or range, right? So we always will measure the same starting point, ending point, and starting point of the second wave up. Okay? There are many variations the chart could look like. Don't get scared by that. That's only because of the options written this way around. That's all. You don't need to dig very deep, just visually understand and accept it. All right, that's about it so far. Now, let's take a look on the visual part. This is double cycle. This is double cycle. See, there are many visual ways they look. See, guys? All right? See? That's all fine. Okay, they all still double cycles. See? Even we had like small spike. Fine. See? And even with the range. So we measure this and this. They have to be equal. If we reach the 100% expansion, they have to be equal. So if that was like 20 candles, that should be also approximately 20 candles. Visually equal. They visually are. Yeah. We are good to go. Okay? And here we go once again. So that's about double cycles. Any questions so far? All good. Perfecto. Clear. Clean. All right. Great. Thank you. Thank you, guys. So the next one on the list, we have triple cycle. Triple cycle consists of three fairly equal waves. And I'll explain what fairly is. It is also known as six-spot tunnel. Take a look on this. Is that a triple cycle? How do we know? The first leg, the second leg, and the third leg, they are pretty much the same. Again, visual. That's where we know that this is a good triple cycle. Okay, now I said it's called a tunnel. A great triple cycle is when you can take all the top spots and all the bottom spots and put them inside a tunnel, call it whatever you want, pipe, I don't care, call it as much as you want. And you have 6 spots, 1, 2, 3, 4, 5, 6. All right, that's what it is about. How do we deal with them? I'll show everything later, but first of all, let's try to understand them. right? All right, so in a special cycle, we will also explain that it is like triple. The only thing is that the first one and the last one, they are visually same, and the middle one is double or triple sized. So if that one was 50 pips, that one is 55 pips, for example, this could be 100 pips or 150 pips or 170 pips, that's all fine. But it has to be visually double or triple. Now I want to give a few notes about the triple cycles, which you should know about the triple itself, right? That's the classical one as we know, right? And same for bearish. Sometimes we have cycles like that. Is that fine? Yes, it's still triple cycle, and this is my point. One wave could be different from the others. Sometimes it could be like this. They all still same size, and that's still fine. One leg could be different. Okay? That could be different, a bit by size, a bit by length, by time. Sometimes it looks like that. One big, one middle, one small. That's also fine. Rare, but that could happen. That's also fine. That's also triple. Okay? Once again, why they look like that? Only because how the option is written and expire. That's all. The protection, the insurance, everything inside. That's all. That's why visually it's different. It took me a long time to define all that into the visual part and put it like in families. Don't waste your time on candle counting or the accuracy of accuracy, not accuracy. How's that called in English? Accuracy of the days, the candles, the pips, whatever it is. Don't waste your time, guys. So that's about a triple and a special cycle, as we know them. Let's take a look a bit of examples. This is a special cycle, bullish one. Okay, now before we go to range, here is one important thing I want you to know. When we know we got double cycle, okay, on each of its levels, 61.8, 161.8, or the 100% expansion, with all the extra coming inside, we know what? That we can start to look for sell. This is basically how we know what direction we trade. This is how we understand what direction we trade. If we are at the end of the cycle, we are looking for the opportunity to go against. Why? Because this is the place where options expire. Do you know what happened when options expire? Tons of money running away. What happens when money is running away? Boom, direction change. This is where we want to go. We want to be with the money, and we want to be with the money when it runs away and switches hand and running exactly to the expiration. That's same for triple cycle. When we are in triple cycle, from here we are looking for sell. All right? When we are here, we are looking for buy. Double cycle, looking for buy. Double cycle down, of course. Now, targets, very simple. For double cycle, our the change of the trend, our target is 38.2 Fibonacci. For triple, 50% of the entire move from here to here, and from here to here. Okay? For double cycle, 38.2. For triple cycle, 50%. Correction of the entire move. Of this and of this. For the special cycle, by ideal, because it's like triple to 50, but we basically are open-minded and we go to 38 down to 50. So until, how do we know basically? When we go down, we will start to see divergences against us, and I will explain that in a few minutes. Okay? But basically when we start to get signs against us, then we know we cash out. By ideal 50, sometimes it's missing it, and that's fine. So to make your life easy and easier and simple, take a look on, for example, New Zealandian dollar had triple cycle up here. 1, 2, 3. What do? We take the Fibonacci of the entire move, and we know our target is where? 50%. Here. Alright? That's about it. Now, this was double cycle here. Right? And our target for double cycle is 38.2. So when we are longing here, this is our final target. When we are shorting here, this is our final target. That's all. For double cycle, this is double cycle, for example. Right? 1, correction 2. Right? Our target is 38.2. That's what I want you to know. That's what you should know. That's all. Okay? The final targets. On the way, we can cash out partials here and there. That's all fine. But for final target is where we are looking to cash out the final target. And this is basically where huge risk rewards comes in, because when you are looking, you got two waves down here. This is your target. From the bottom to here, that's 1,000 pips. Of course, we don't trade a weekly chart. We trade like 4-hour, 1-hour chart, right? We're looking for options to long here. So we can find a trade with, let's say, 70 pips risk somewhere, and let's say 700 pips profit. That's 1 to 10. This is how it's done. That's how and where we can get a monster risk reward on the big cycles, on the healthy one, the heavy ones. Now, I want you to understand one thing, guys. The big targets mean if you just enter and let it go, it means that sometimes you will have to wait, let's say, 4 months or 6 months or more until target would be reached. Yeah, that's where you can make big money, 1 to 10, 1 to 20, 1 to 40 sometimes. Rare, but could happen and happens. The question is, are you built for things like that? And the answer is normally most of us no, for one reason, because if we would all trade $10 million, one trade per year to do 1 to 10 risk reward, yeah, that's fine. 10% from 10 million, that's 1 million. That's more than enough per year. But most of us don't trade such big money, right? Most of us trade 10, 20, 30, 40, $50,000, some 2,000, 5,000, everyone with his own abilities. So our goal is first of all to grow and not just how to make a living. Remember that. Make a living is very, very tricky thing. Everyone talk about, I want to be full-time trader and trade for a living. Don't forget that in order to do that, you need the deepest pockets possible. And then your activity could be lower. But as long as your pockets are not that heavy and deep, your first goal is to grow. That was my first goal for many years. to grow and grow and grow until I reach the level where I can trade for a living without wasting my entire day. That's the goal. That's the idea. And I want you to understand it, because trading for a living inside itself is very tricky thing. Okay, you cannot make a living from $10,000 unless your goals are like $500, for example, per month, which I guess it's not. You first of all have to stick to grow. Remember that. Okay, when you grow, then you can trade 1 or 2 trades per year and make it enough. So we spoke about the cycles, we spoke about the targets. How do we trade that? Different webinar. The next steps. Okay, that will be the final one for today. So we have the cycles types, where they come. Now one more cycle, and then the importance of how do we know when cycle is over or not. Let's go back. So the next important cycle we have on the list is range. Range is normally something that scares everyone for one reason. No one knows how to deal with that, and that's fine. Range cycles. It usually comes after a trend, which makes sense, right? Any of other cycle types. So double cycle and then a range, triple cycle, then a range, special cycle, and then a range, right? And with divergence, which I'll talk about in a second. 2 consecutive false breaks or 2 false breaks top and bottom are very common, and this is how we define beginning of the range. And range could be horizontal, channel, or consolidating triangle, wedge, or any other way you choose to name it. Now here is what I'm talking about. About the false breaks, we will talk about this, about everything very deep on the next webinar, but I just give you the basics now. We gotta move 2 waves, right? This bottom was false breaking. What is a false break? In just the basics, breakdown, attempt to break down, which failed. What fails mean? We got below and we got up again above this level, closing above. Once that happened, that is a false break. Then we got to move above this high, boom, attempt to break high, and boom, false break and retrace down to close below. 2 false breaks in a row, we know this is our potential range. Some important fact about ranges are normally twice longer than trend. So if that was your trend before, the range could be twice longer, sometimes even more than twice. So if that was like, I don't know, 30 candles, that could be 60 or more. Sometimes it would be less, but normally it's twice bigger or even more. Why? Because of the fact that market is ranging 70% of the time. Only 30% of the time it's trending. Now, if it's 70% of the time it's ranging, we have to learn how to deal with possible ranges, right? Remember that. So this is how it looks like. How we trade it we will talk about later on, of course. 2 waves down, and then you see we come into triangle. Triangle is the same range, just that the top's going down, the bottom's going up. That's all. All the rest is the same. But because we cannot define false breaks inside, what we do is each of the legs inside triangle is a cycle by itself. Double, 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 triple, double. All right? Each of the legs inside is a cycle by itself. This is how we define triangle style of a range. Here you go, double cycle down, 1 false break here, 1 false break here, and that means we are entering inside a potential range. As I said, range could be in 2 ways. Here you go. One is that we got double cycle or triple cycle, and here we got one false break, two false break, two in a row on the same direction. That could happen, and that means that this could be our potential range now. Okay, two false breaks in a row, one false break here, one false break here. The second way and the most popular way is that it comes like this. And here we got false break and false break. One above the top, one above the last bottom. Okay, and this what creates for us another possible range. Two false breaks, one up, one down, or two in the same direction, create for us a potential range. Really simple. That's what happened here as well. Two waves down, one false break here, one false break here, and that means we are entering a range. One more important fact is once we are in a range, which starts with one false break, two false break, up to two more false breaks, that's fine. The rest would be very likely reliable breakouts. So if that's what happens, this should be very likely a reliable breakout. Okay? So if we observe this example, we had one false break, another false break, another false break, right? And another attempt for false break. That means that the next breakout down or up, in that case up, would be reliable and flying up. Normally, of course, that's not a mandatory rule. That's how normally reliable breakouts happen. All right? This is about the range. Now, here comes the interesting part. And I want you to remember that. Very, very, very important. Cycle must come with divergence. Cycle without divergence is not completed cycle. Remember that. Cycle without divergence is not completed cycle. And a divergence must appear on the same time frame that the cycle does. Must. So what is divergence? I believe every one of you know. We have enough webinars about divergences in the media zone. You're invited and encouraged to go and to watch that about the divergences, all the types and the differences and so on. But here I wanted to know cycle has to come with divergence. Now, here how it could come. Divergence can come between leg 1 and leg 2, or it could be inside the second leg alone. Divergence could be between the tops of both legs, or if this is the first leg, this is the second one, it could be only here on the last part of the cycle. That's all fine, as long as there is divergence. Take a look here. Triple cycle down, divergence between all the lows, and also, in that case, only on the last one. Okay, divergence just in a basic is when the indicator shows the opposite direction to the trend. So if here we got lower lows, here we got higher lows. That's just the basics. And I really want to ask you, those who have no idea what divergence is, please watch the webinars about divergences. We have it inside the members area, the media zone. It's there for you guys. Okay, double cycle ending with divergence. Now divergence could be, and that's important, it could be on the histogram, it could be on the moving average of the histogram, this, or both together. I don't care how. Each of the types is acceptable. Here again, two waves down and divergence. In that case, in both. Two waves down and divergence. Special cycle up and divergence. You see where divergence appear, guys? Not from the first high, but only on the last part, and that's fine. That's fine, as long as there is divergence. It could be on any of the spots or inside the cycle. Triple cycle up, divergence. Triple cycle down, divergence. Not on the histogram, but on the moving average, and that's fine. Don't get scared by that. That's still correct. Two big waves down and divergence. Two waves down and small divergence on this part, very small but still divergence, and the big divergence appears here. And again, that's all fine. Basically that's 61.8. So you see this is the first measurement, this is the second one. You see? This is twice as long as this one. Alright? Same here. Boom and boom. Alright? Now, before I thank you for your time, I want to give you a few more important tips, guys, and then questions. What is this? Who can help me? How do we name that? Double, triple, or special? Triple cycle it is. Very, 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 very correct. Well done, guys. And what is this? Double cycle. Classical. Why I show you that? Because there are sometimes cycles that we can say it's double, we can say it's triple, or we can say it's even special. All depends what you choose. And that's special cycles. If you can name that few ways, that's a very special, powerful cycle. It could be double, it could be called triple, it could be called special. The only one it cannot be called is range. Okay? If you see that, that's more than fine. Tip number one. Tip number two is that sometimes each of these legs will include cycles inside it. So this one leg here could be special cycle by itself, or this could be double cycle by itself, or this could be triple cycle by itself. So if you cannot clearly define specific leg as a cycle, that means that this is just one leg from the other time frame. If anything, there cannot be a situation like this. That's nothing. There is no 4 cycle or 5 waves or I don't know other names around. No. If you cannot define that clearly, that means it's just one leg from the bigger cycle. Tip number 2. Tip number 3, magnet zone. Sometimes we have cycles that bring us to the same zone. We have 3 different cycles marked on different colors, maybe found on different time frames, that bring us to the same zone. This zone is called a magnet zone. This zone is called a magnet zone. When you have a magnet zone combined by a few different type of cycles, you know this is a monster area. Here we are looking for what? Buy or sell, guys? Sell, correct. Why? Because it's end of cycle or ended in few cycles in that case. And it's about, the options are about to expire, which means money is about to run out and we are going to trade that. All right, tip number 3. Tip number 4 is just a second. Let's make sure I don't forget nothing. Is this? Yes. Okay. Tip number 4 is going to be basically normal question everyone asks. So why do we trade end of cycles? Why don't we trade the second leg around? Right? I am sure that this is like here. Why don't we trade that? Now that's a normal question. And here's the thing. When cycle completes, we know option is about to get expired. When option expire, which means there will be normally a fast, strong move, if the big money was involved for real, there will be a strong move to the opposite direction where we can make quick money. To trade the second way, the second leg of the cycle, that's doable, but that's much more advanced. And in order to help you around, how do we trade and why not? You can, as long as you do not have divergence against you. So if you have this leg created, you got correction created, and this leg is going up, and you have no divergence against you, which means bearish, you can still try and long that. Now, how do we combine cycles from all the time frames, weekly, daily, 4-hour chart, and so on, and trade it? I'll show you on the last webinar today. Okay, but this is basically what I want you to understand. And now to the last part, guys, part that will help us also on the next webinars. I call it the principle of 2 candles. And I want to show you something, and I want you to answer my question after that. I'll draw now 2 moves. I want you to try and think and tell me which one is correct, which one isn't, okay? That could be, let's say this is double cycle here, all right? And the same idea here. Which one is correct double cycle, which isn't? They look the same, right? Just try to think. Which one is correct, which one is wrong? This is number 1, this is number 2. Which one is correct, which one is wrong? Two is what, correct or wrong? Two correct, one wrong, exactly. Why? Let me explain, guys, here. There is one thing is called a principle of 2 candles. How do we know that a move ends if there is a correction? What is a correction? A move against. What is a move against, and how do we define a move against? If it was deep enough. Now, we can take a Fibonacci from here to here, and if this bottom actually reaches at least 23.6 of the Fibonacci level, that's fine, that's deep enough. But that's not really correct, because what is correct, again, because of the options, the way they are created, is if this bottom breaks, if this end of correction is lower than the low of the last 2 candles of the previous move. What is the previous move? Move up. Where are the last 2 candles that created higher highs, higher lows? These two. This and this. The last higher highs and higher lows. In other words, this level has to be broken in order than that be called a correction. This is a tip that no one will ever give you nowhere. I want you to remember that. It helps a lot to understand what is a good correction, what is not, what is a good cycle, what is not. Here, this correction, why it's good? Because if we compare to the last two candles of the previous move, that's the last two candles, we break below this low. Therefore, this is correct, this is wrong. If this correction did not break the last two candles, that means that this is the entire move, one leg up, not two, but only one. One more important thing. Sometimes there will be moves like here, but with one inner candle, like this. What is an inner candle? A full candle from high to low that is blown inside the candle before. Let me show you an example. Here, what are the last two candles here creating higher, higher, higher lows? The red and the green, or the two greens? Exactly, the two greens. Because this red one is inner candle. Its high and its low are inside the previous candle. So that's two green candles. They define the last higher highs, higher lows. And that means that this low must be broken in order for that correction to be valid. Okay? Now I want to show you not valid corrections. Is this correction is valid, yes or no, guys? Take a look here. This correction, is it valid, yes or no? Think about it. No, exactly. Why no? Because we take a look on the last two candles created higher highs, higher lows on the previous move. Where is the previous move? This. That's the last two candles. That's the low. Last two candles created higher high, higher lows. This did not break below this low, which means this is nothing, not even a correction. We don't treat it. I show it to you now. And on the next webinar about false breaks, you will understand how important it is. And remember this principle, guys, it will save you a lot of time to understand when it's good correction or not when you are looking to define moves and cycles. Any question for now? That's very good to hear, dear. Thank you very much. All right. That's good to hear, guys. So now you have the first part, the first important part of the cycles, the basics. How they look, what they represent, what are we actually looking inside. Next webinars, that will be step number 2 webinar, we will talk about false breaks and convergence principle. And the last one today would be to talk about how to trade it all together. Thank you for being here. I'll see you in the next ones. Ciao.